As of 11:26 a.m. Eastern Time on September 22, 2025, Opendoor Technologies, ticker symbol OPEN, is trading at $9.12 a share, down about 4.7% for the day. The stock opened at $9.17, has hit a high of $9.45 and a low of $8.71 on a massive volume of over 101 million shares. This isn't just typical market noise. It's the kind of volatile, high-stakes trading that signals a deep division in how the market perceives a company. While many investors are looking at this sharp intraday drop as a sign of trouble, what's really happening under the surface is a fundamental reevaluation of Opendoor's entire place in the housing ecosystem, especially after its recent and somewhat staggering ascent. The expectation was that after a brutal period, the company had finally turned a corner. But the reality of today's price action suggests that the path forward is far more contentious and uncertain than the recent rally would have you believe. The common belief surrounding Opendoor over the past year has been one of a dramatic, almost Lazarus-like comeback. This is a stock that was left for dead, trading well under $1, and has since rocketed up, becoming a poster child for the market's renewed appetite for high-growth, high-risk tech names. The narrative is straightforward. A change in leadership, a strategic pivot, and a slightly more stable housing market have set the stage for a grand recovery. Investors, particularly those active on platforms like Robinhood and SoFi Invest, have piled in, chasing the momentum and the story of a disruptor finally finding its footing. The expectation is that Opendoor, having survived the iBuying winter that claimed competitors, is now positioned to dominate the digital real estate landscape. However, the reality is that the foundation of this rally is built on something far less certain than concrete. It's built on a complex interplay of macroeconomic dependencies, a business model still fighting to prove its long-term profitability, and a stock price that has, by some measures, run far ahead of the fundamental improvements. Let's dissect the recent market activity to understand this tension. Today's significant trading volume isn't just retail enthusiasm. It points to large institutional players making decisive moves. When you see volume north of 100 million shares, it suggests that major funds, perhaps those managed through Fidelity Wealth Management or accessible via interactive brokers, are actively adjusting their positions. This could be profit-taking after the immense run-up, or it could be the establishment of significant short positions by those who believe the rally is overdone. The analyst consensus further complicates the picture. While the stock is trading near $10, the median analyst price target sits closer to the $2.65 mark. That is not a small discrepancy, it's a chasm. It signals a profound disconnect between the bullish sentiment driving the stock's momentum and the cold, hard financial modeling being done by Wall Street analysts. They see a company that, despite a recent surprise in adjusted EBITDA profitability, is still guiding for sequential revenue declines and faces enormous headwinds. The expectation is a V-shaped recovery. The reality presented by professional forecasts is a long, arduous climb with no guarantee of reaching the summit. The macroeconomic environment is the invisible hand guiding much of Opendoor's fate. The iBuying model, which involves purchasing homes directly from sellers, making light renovations, and then reselling them, is exquisitely sensitive to the health of the housing market. Recent data from September 2025 shows a mixed and rotating market. While the total value of U.S. housing has hit a record, the growth has slowed, and former boom markets in states like Florida and Texas have actually seen value declines. Mortgage rates, though they've dipped slightly, remain a significant barrier to affordability for many buyers. Opendoor's success depends on its ability to accurately price homes, maintain a thin margin on the spread, and turn its inventory quickly. In a market where some regions are cooling and buyer demand is tempered by financing costs, this becomes a high-wire act. The company's ability to manage inventory acquired at higher prices is paramount. This isn't a simple tech platform, it's a capital-intensive balance sheet business masquerading as a tech company. And that reality is what makes it so vulnerable to broad market shifts that are entirely out of its control. Many retail investors using online investing tools may not fully appreciate this deep cyclical exposure. So what exactly does Opendoor do? At its core, the company provides a service that offers speed and certainty to home sellers. Instead of the traditional process of listing a home, staging it, holding open houses, and waiting for a qualified buyer, Opendoor makes a cash offer, often within 24 hours, based on its proprietary pricing algorithms. For this convenience, it charges a service fee. The company then holds the home as inventory, performs necessary repairs, and lists it on the open market for resale. This iBuying model aims to capture a small profit on the transaction. The business has recently undergone a significant strategic pivot, moving from a single cash offer product to a broader platform that partners with real estate agents. This shift is an admission that the pure iBuying model might be too capital-intensive and risky to be the sole engine of growth. By creating a marketplace and providing tools for agents, opendoor is trying to diversify its revenue streams, moving towards a more asset-light model that can generate fees without having to carry billions of dollars in real estate on its balance sheet. This is a critical evolution, but it also puts them in more direct competition with established players like Zillow. Looking at their financial performance, the second quarter of 2025 was a pivotal moment. The company reported revenue that beat expectations and, more importantly, achieved its first quarter of positive adjusted EBITDA in 3 years. This was the spark that ignited the massive rally. It gave credence to the turnaround story. However, a deeper look reveals a more nuanced picture. While adjusted profitability is a positive step, the company's guidance for the next quarter pointed to a significant sequential revenue drop. Furthermore, GAAP profitability remains elusive, and the company is still burning through cash. The success of one quarter, driven by disciplined cost management and favorable inventory management from a specific period, does not yet constitute a sustainable trend. The challenge for opendoor will be to prove that it can generate consistent profits across different housing market cycles, not just in moments of stabilization. Many retail investors, particularly those new to self-investing through an individual brokerage account, may not fully appreciate the headline-grabbing adjusted profit figure without fully appreciating the underlying cash burn and the weak forward guidance. Comment below with your thoughts. Do you believe opendoor's new agent-led platform strategy is the key to long-term profitability, or is the core iBuying model still too risky? The future outlook for opendoor is a study of contrasts, a landscape of significant opportunity fraught with substantial risk. The optimistic scenario is that the strategic pivot to a platform model succeeds brilliantly. By empowering agents with its technology and cash offer capabilities, opendoor could create a powerful ecosystem that captures a much larger share of real estate transactions with lower capital risk. If the housing market continues to stabilize and mortgage rates gradually decline, it would provide a favorable tailwind, allowing the core iBuying business to function more predictably. In this future, opendoor leverages its brand recognition and technological infrastructure to become an indispensable tool for agents and consumers alike, finally achieving consistent GAAP profitability and justifying a valuation far higher than where it stands today. It would represent the ultimate victory of expectation over a harsh reality. However, the pessimistic scenario is equally plausible. The reality is that the housing market could face another downturn, pressured by wider economic weakness or a resurgence in inflation that forces interest rates higher. In such an environment, opendoor's balance sheet would be once again exposed. Holding a large inventory in a declining market is a recipe for significant write-downs and losses. The pivot to a platform model might not gain traction quickly enough to offset weakness in the core business, especially as it competes with entrenched incumbents. Furthermore, the stock's current valuation already prices in a great deal of success. If the company fails to meet the market's high expectations for growth and profitability, the same momentum that drove the stock up could reverse just as quickly, sending it back towards its lows. The institutional money that appears to be selling today could be the leading edge of a broader sentiment shift. In conclusion, the story of opendoor technologies is a classic battle between a compelling narrative and a complex and challenging reality. The expectation, fueled by a spectacular stock run and a shift in strategy, is that of a tech disruptor on the cusp of conquering the real estate industry. It's a vision of streamlined transactions, data-driven efficiency, and sustained, profitable growth. The reality, however, is a company deeply tethered to the cyclical and unpredictable housing market, a business model that is yet to prove its profitability over the long term, and a stock price that has, by some measures, already outpaced its underlying fundamentals. Today's volatile trading session is a microcosm of this conflict. While the allure of the turnaround story is powerful, the prudent investor, whether using Schwab Intelligent Portfolios or trading actively through interactive brokers, must weigh that potential against the very real risks embedded in the company's balance sheet and the macroeconomic landscape. The path from here will not be a straight line, and the tension between what opendoor hopes it will become and what it actually is will define its trajectory for the foreseeable future.